Eric Wade claims to know the smartest way to invest $10,000, and these stocks will create more millionaires in the coming years than any other investment. I reveal the stocks in this video so you don't have to buy Wade's newsletter. Just keep in mind, no paid or proprietary info is given away in this video, and it's all guesswork based on clues in Wade's publicly available sales presentation. Before we do anything, let's look at some recent publicly available stock picks from Wade to see if he's trustworthy. Wade made 4 recommendations in January 2021, and the first was Bitcoin. It's been up and down since then, but right now it's tripled. The second recommendation was Amazon, and while the stock is up overall, it's trailing the market in the same time period. The third stock was Alphabet, and this stock has done well. The fourth stock recommended in January 2021 was Adobe, and this stock has not done well since. Wade recommended UiPath in January 2024, and this stock has done really badly and lost half of its value. He recommended the crypto Hedera in February 2024, and this asset has doubled since then. All the stocks Wade is pitching in this teaser are in the robotics sector, and there's 3 in total. Here's the clues Wade leaves for the first company. For example, one of the companies I'm excited about is a global market leader in AI robotics. This 140-year-old company launched the world's first commercially available industrial robot back in the 1970s. Today, it builds entire smart factories, and its AI software makes robots smarter and helps customers like Amazon, Microsoft, IBM, Honeywell, General Electric, and Ford automate their processes. This company is ABB, and you can buy it over the counter with the ticker ABBNY. ABB is a global technology company headquartered in Zurich, Switzerland, that specializes in electrification, automation, robotics, and motion solutions. The company has a long history dating back to the late 19th century and was formed in 1988 through the merger of Sweden's ASEA and Switzerland's Brown, Boveri, and CE. Its offerings include electric vehicle charging solutions, factory automation systems, industrial motors and drives, as well as control systems for power grids and large-scale facilities. ABB operates in over 100 countries and serves industries such as utilities, transport, manufacturing, and energy. I think this stock is a borderline buy, and here's why. First is electrification boom, riding the energy transition wave. ABB's electrification division is capitalizing on the global push for renewable energy and data center growth, with Q4 2024 showing strong order growth in these segments. However, trade tariffs and market uncertainty could crimp margins, making it a cautious bet. Second is robotics spin-off, unlocking hidden value. ABB's plan to spin off its robotics division, a global number 2 player with $2.3 billion in 2024 revenue, could boost shareholder value by letting both units shine independently. But the execution risks and costs of the split keep it from being a sure thing. Third is solid financials. Cash flow keeps it steady. With $3.9 billion in free cash flow for 2024 and a 22% net profit jump in Q1 2025, ABB's financial health is rock solid. Still, currency fluctuations and tariff-related costs could dent reported numbers, so it's not all smooth sailing. Fourth is global footprint, tariff-proof-ish operations. ABB's local-for-local strategy, 75 to 80% U.S. sales from domestic production, and 85 to 90% in Europe and China, shields it from some tariff pain. Yet no company's fully immune to global trade disruptions, which adds a layer of risk. Fifth is AI and innovation, betting on the future. Investments in AI-driven solutions like ABB Ability, Genix Copilot, and medium voltage UPS for data centers position ABB for long-term growth in high-demand sectors. The catch? R&D costs and competition in tech-heavy markets could pressure short-term profits. Sixth is acquisition momentum, growth through smart buys. ABB's ramping up acquisitions, targeting $200 million in added revenue from low-carbon solutions, which strengthens its portfolio. But integration risks and a crowded M&A landscape mean it's not a guaranteed win. Seventh is positive 2025 outlook, growth with a side of caution. ABB forecasts mid-single-digit revenue growth and improved margins for 2025, backed by a strong order backlog and market tailwinds. However, geopolitical risks and potential economic slowdowns make this a watch closely pick rather than a full-on buy. I'm going to reveal the rest of the stocks in about 20 seconds, but before I do that, I want to remind you to click the link in the description to check out AlphaPix. I reviewed over 100 stock picking services, and AlphaPix performs the best and actually beats the market easily. If you click the link in the description, you get $50 off AlphaPix. So go ahead and click that link and take advantage of this amazing deal. Here's the clues for the second stock. Another one of my favorite plays just spent $290 million to buy a privately owned robotics business. In doing so, It became one of the world's leading AI robotics companies virtually overnight. Its customers include Google, Toyota, FedEx, CVS, Lowe's, Ford, and McDonald's, to name a few. The stock was up more than 40% last year, but I think the real gains are just getting started. And I'm not the only one who believes this stock has massive upside. Four of the greatest investors of all time, Jim Simons, Steve Cohen, Joel Greenblatt, and Paul Tudor Jones, have quietly built multi-million dollar positions in this stock. This company is Zebra Technologies, and the ticker is ZBRA. Zebra Technologies is an American company headquartered in Lincolnshire, Illinois, that provides a wide range of technology solutions designed to help businesses track and manage assets, people, and transactions in real time. Founded in 1969, Zebra initially focused on barcode printing, but has since expanded into mobile computing, data capture, radio frequency identification, and real-time location systems. I wouldn't buy this stock, and here's why. First is skyrocketing costs crushing profits. Zebra's cost of sales jumped 22.3% year over year in Q4 2024 due to pricey raw materials, and selling expenses rose 11%, squeezing profitability. If these costs aren't controlled, margins could take a serious hit. Second is debt mountain looms large. With $2.09 billion in long-term debt and an 18.9% debt growth rate over 5 years, Zebra's high interest expenses, like $98 million in Q4 2024, could strain its financial flexibility. Third is growth is slowing down. Revenue growth has cooled off compared to the pandemic-fueled highs, and with enterprise spending tightening, future acceleration looks uncertain. Fourth is stock slump signals. Weak momentum. Zebra's stock has tanked 26.5% in the past 3 months, hitting a 52-week low of $237, reflecting investor doubts and a lack of near-term catalysts. Fifth is overvalued and underperforming. Despite a low return on invested capital and flat earnings per share over 5 years, Zebra trades at a pricey 22 times forward free cash flow, making it a risky bet for value investors. Here's what Wade says about the last stock. I can almost guarantee you've never heard of the third stock in my report. But your house is likely already full of devices and products that have been handled by one of this company's AI robots. From TVs, phones, and tablets to ovens, fridges, and washing machines. Last year, this company spent more than $100 million building a 15-acre facility in the Midwest and packed it with state-of-the-art robotics and automation. This company is Fanuc Corporation, and it's an over-the-counter stock with the ticker FANUY. Fanuc Corporation is a Japanese company that specializes in industrial automation. It's one of the world's leading manufacturers of CNC computer numerical control systems, robots, and factory automation solutions. I think this stock is interesting, and a buy. Here's why. First is robotics ruler. Fanuc's gripping over 50% of the CNC market. Fanuc holds a commanding 50% global market share in CNC systems and is a leader in industrial robots, fueling growth as automation demand spikes. With labor shortages and EV production driving robotics, Fanuc's set to dominate this $5.18 billion revenue stream. Second is China and India's surge. Fanuc's tapping explosive growth markets. Fanuc's seeing strong order growth in China despite tariff risks and expanding in India's booming manufacturing sector. Analysts are hyped about these regions, with Fanuc's robot orders up 27.5% year over year, signaling massive potential. Third is Fortress Finances. Zero debt and cash flow for days. Fanuc's balance sheet is rock solid with no debt and high free cash flow, generating 32.86 billion yen in net income last quarter. This financial muscle lets them invest in innovation and shrug off economic hiccups. Fourth is dividend dynamite. 1.3% yield and buybacks to boost returns. Fanuc pays a steady 1.3% dividend yield, $0.1 per share semi-annually, and targeted 50 billion yen in share buybacks for 2023 with more expected. This combo rewards shareholders while signaling confidence in future growth. Fifth is bargain buy. Fanuc's priced for a steal. With a PE ratio of 29.55 and a market cap of $28.83 billion, Fanuc's trading at a fair value compared to peers, with analysts forecasting a 6.87% stock price rise in 3 months. Recent earnings beats and raised guidance make it a steal. And make sure to click the link in the description to check out Alpha Picks and get $50 off this amazing service. And if you missed my last video, make sure to check it out. In that video, we looked at a bunch of small stocks Motley Fool says will gain 50,000%.